had made a comment to you that the diversification I saw up there looked somewhat similar to all-weather portfolio of Dalio.
Mm-hmm.
And I like his thinking on risk management. So I don't know whether this question is related to, or who's going to field this. Question number one is, why did you pick Nicola out of everybody in Canada? And number two, I'd like to know how risk management is looked at and why those categories are picked and how they're manipulated as times change, because the risk would change with time, and how those are rebalanced.
Well, number one, there is no such thing as a risk-free investment. You know, in finance, we always assume the risk-free investment, and we assume that to be a T-bill. In Canada, your risk-free T-bill is down 30% against my risk-free T-bill. So it's not exactly risk-free. 10 years ago, I was in Montreal, and the loonie was at, I think it was at 67 cents. Was that what it was? It was about that. And I was at the biggest bond brokerage firm in Canada, speaking to this group, sitting around a table. Somebody says, what do you think is going to happen to the Canadian dollar? Because it had just been doing this. Says, it's going to go to parity. And they laughed at me. They literally laughed at me. I said, no, it'll go to parity. And some of them would call me up when it hit parity and remind it, because I'd, you know, and it went way on past parity. So there's no risk-free environment. What you have to do is you have to manage your risk, and you have to look at your expectations, and you have to try to say, what environment are we in? Well, for instance, one of the things that I'm comfortable with on private credit is it's generally short-term. You can generally bulk up 10,000 loans and put them together that are smaller loans that have a statistically reasonable period of payment. You can do set-asides. You can tranche off the lower the equity risk. There's things you can do to manage your risk. Same thing with real estate. Unless we all just start dying and go away, we're going to need that real estate. So businesses are going to want to rent it. You know, there's things you can do to produce that income. There are things you can do that, you know, Nicola started doing, which was hedging out his risk. So when you ask why I picked him, I liked the way he thought about risk and risk management. I like the way that he diversifies strategies. I mean, so many wealth managers, so many economists, big financial wirehouse. What do we call it in the U.S.? You call them wirehouses here? We call them the wirehouses, like the Thundering Herd and the you know, where they've got 10,000 brokers. And their strategies, basically, they want to sell you stocks and bonds because that's what they got in their portfolio. And so they give you diversification. They say, well, we got large cap and small cap, and that means you're diversified. No, it doesn't. It means you got stocks. That's a bucket. It's not diversification. So you know, and it's risky, and I want to know how I'm going to hedge it, because I'd rather have that steady return, because that's how you compound. And my personal answer is, I have had to talk to people who are down 30 or 40%. I've had some funds that went down that much, and I don't want to talk to anybody ever again in my life and say, well, this is why that happened. I just don't want to do it. So, not that John couldn't, you know, you guys are gods or anything, or you couldn't have a year that's really uncomfortable. But I don't think they're going to do anything just ride along and do something stupid. And I'm not being disparaging here, but about 90% of wealth managers they can get involved in their own stuff and just get caught up. And I just felt the way John does it is the way I'd go about doing it.
That
Yes,
answer your
sir.
question? Process is, the reality is that all of our clients they go through kind of a financial planning process, and obviously we put together a portfolio based on those individuals and their objectives. But just to talk to you kind of what John was talking about, some of the things that we've done, for example, traditional bonds, for example, with low yields, we've created private debt pools of assets where obviously you can get much better yield, but still with a lot of protection. We have over $1 billion of hard asset real estate in Canada and the U.S., which are partnerships that we invest in with our clients. We do private equity style investing, so things that aren't necessarily related or correlated to kind of traditional stocks and bonds. And so, John is definitely a visionary, and as our firm has grown, we're constantly trying to stay ahead of the curve and look for new alternative investments where we can get really just better risk-adjusted returns. And as John Mauldin spoke about, is trying to just have a smoother ride for our clients.
And one of the things they do too, and John did this early on, was you're not coming in and you're not buying a lump. This is what you get. They tailor it. And so, I mean, not everybody, because you're not going to have the same needs that he does or she does. So I get very uncomfortable with one-size-fits-all advice.